Hey everyone, welcome to another video. In this video, we'll discuss how income from share market, typically the Indian share market, is generally taxed. So if you're dealing with the stock market or in the share market, you generally hold two positions, one as an investor or as a trader. And therefore the aim of the video is to find out how income from share market as an investor or as a trader is generally taxed. So let's jump in. First, when you're an investor, dealing with the stock market is not a part of your regular scheme of things. It is not part of your regular profession or business. And therefore it forms a part of your other income. In other words, it's called capital gain. So if you're making a profit, it's called capital gain. If you're making a loss, it's called capital loss. So as far as equity shares are concerned, equity oriented funds are concerned, or mutual funds whose investment in equity is more than 65%. If the holding period is more than 1 year, and if you're making a profit, it's called long-term capital gain. If the holding period is less than 1 year and you're still making a profit, it's called a short-term capital gain. In other words, if you're holding equity shares or equity-oriented funds and you're selling it after 1 year from the date of purchase and you're making a profit, that profit is called a long-term capital gain. If you're holding equity shares or equity-oriented funds and you're selling it within 1 year from the date of purchase and you're making a profit or a gain, that is called a short-term capital gain. What about the taxes? As far as short-term capital gain is concerned, there's a fixed rate of 15% irrespective of the gain limit or the profit limit. But as far as your long-term capital gain is concerned, on the first 1 lakh, there is no tax on the 1 lakh of gain. After 1 lakh, there's a fixed rate of 10%. What about non-equity oriented funds or debt funds or mutual funds in which your investment in equity is less than 35%? As an investor, if you're holding it for more than 3 years and if you're making a profit, it's called a long-term capital gain. If the holding period is less than 3 years and you're making a profit, it's called a short-term capital gain. To simplify, if you're holding any non-equity oriented funds or debt funds and you're selling it after 3 years from the date of purchase and you're making a profit, it's called a long-term capital gain. If you're selling it within 3 years from the date of purchase and you're still making a profit, it's called a short-term capital gain. What about the taxes? Whether it is a short-term capital gain or a long-term capital gain, as far as your debt funds or your non-equity oriented funds are concerned, there's no fixed rate of tax. It is treated as a normal income, which means when you compute your total income at the time when filing your income tax return, you treat it as normal income like your professional business income and then tax it as per the normal income tax slabs. Now, as an investor, you could also make losses, whether it is from equity shares, equity-oriented funds, or from debt funds. Whatever the case may be, if you are getting a long-term capital loss, then this particular loss, when you compute your total income at the time when you file your return, this particular loss can only and only be set off against a long-term capital gain. Whereas, if you make a short-term capital loss, this particular loss can be set off or knocked off not only against a short-term capital gain, but also against a long-term capital gain when you compute your total income. And if it cannot be set off or knocked off at all, it can be carried forward for 8 financial years into the future. Now, what happens when you deal as a trader? Now, when you become a trader, your frequency of trades in the stock market increases. It becomes a primary source of revenue or income for you. It no longer is like your side income, it becomes your business or your professional income. And therefore you have two types. From trading, you have speculative business and non-speculative business income. Your intraday trading, that is buying and selling on the same day, playing with the price movements in equity shares so as to book a profit on the same day, is called speculative type of businesses. Otherwise, it's called non-speculative type of business. Your futures and options trading, although it comes under the general category of trading, it is not a speculative, rather a non-speculative type of business. And as far as taxes are concerned, on your speculative or non-speculative income, there is no specific tax rate which is applicable. It will be taxed as per your normal income, which means when you compute your total income at the time when you file your return, you treat it as your normal income and then normal tax slabs and rates will be applicable on the same. But what if you make a loss? If you make a speculative loss, then this loss, when you compute total income, can only and only be set off or knocked off against a speculative gain. If it cannot be knocked off, you can carry forward for 4 financial years into the future. And if you're making a loss and that is non-speculative in nature, then it has a benefit of setting off or knocking it off against any income other than salary income, which becomes more beneficial to you. So therefore, I hope I was able to make things clear through this particular video. If you like the video, please do show support to us by hitting the like button. If you want more videos like these on a regular basis by way of notifications, you could also think of subscribing to the channel. Till then, I'll see you guys in the next video. Take care and thank you.